Hello everyone. So for this video, we'll put our focus more, or I'm going to relay my learnings to you regarding the different stages of price action. Okay, but before we go further, it's important to emphasize that people must have a general understanding of what candlesticks are. What's the difference of what's the definition of trends? What's the definition of waves before we can be able to uh, understand and appreciate this the different stages of price action. Okay, because this is now looking at the bigger picture. No, okay, so the four stages of price action happens every time in every chart, and there might be some slight differences in the form or length of time per stage, but I think the theory is essentially the same. We begin first with stage one, the accumulation, right here. So after a steep downtrend, the public has lost interest in the stock, or is too traumatized not to even look at it. And price reaches rock bottom after exhausting the selling spree and is now starting to consolidate. So what seems to be dead meat to the general public is actually um, a feast for big funds. And in the accumulation stage, price moves sideways like this in a range when the public seem to have lost interest or probably got frustrated after the massive sell-off in the previous trend, while big funds on the other side and institutions are accumulating or buying quietly. All right, so that consolidation or range um, that we see in this stage one is not just some sort of random event. No, if we ever wondered why the previous steep downtrend ended in the first place, well, it's not because you and I stopped selling. It's because someone is buying, and he is buying big time. So for price to stop dropping at a certain level when everyone is selling and everything seems gloomy, no, there must be something big that is catching all those shares that we are tossing. So after some time, um, the public then realizes that price here isn't going down no matter how they sell, and they start to think that maybe price may have hit rock, uh, may have hit bottom already. And then a bullish sentiment starts to fill the air as stock market analysts and forums notice that the stock may be too overextended to the downside, no, overextended to the downside already, and may be ripe for a timely recovery. And probably at this point, the large funds have already accumulated huge volumes of shares that the public unknowingly sold to them. So now it's time for a breakout as we enter stage two. Okay. Stage two is also called as the markup. So something that won't go down must be going up. So at this point, half the sellers have already exhausted their supply, and the other half is now changing their minds and having second thoughts on selling further. So just as fear is slowly fading, good fundamental news comes out of nowhere, and it can be earnings, it can be dividends, or some rumors that's music to the public's ear. And soon enough, the combination of the half hearted sellers and some unfilled large buyers and interested speculators, this fuel a sudden surge of demand and overwhelms any remaining sellers at the resistance. And that point is also known or termed as the breakout point. And then this leads to a breakout on high volume and thus eventually start a new uptrend. Now, wave counting also begins, and this renewed urgency to buy, this propels price into a steady formation of higher highs. So pullbacks are also bought, forming higher lows, and in the chart, What you see are a series of long momentum candles in the direction of the breakout. So remember how the long momentum candles, how they appear, how their bodies appear, okay? So swing traders get in and out of short trades, while position traders have embedded themselves somewhere within the trend and are sitting tight as long as the trend is still intact. And then we have this bullishness, which attracts more bullishness, and then news spreads about this wonder stock that is making everyone in the stock market a little bit richer every day. So those who are not able to get in see the stock inching higher and higher, and trading groups and forums are cheering, and the public realizes that perhaps it's time to bet big on this one. Greed sets in, panic buying occurs, and then everyone wants to get a piece of the pie at whatever price. So buyers pile up at the bids and sellers are scarce at the ask. So what we are about to enter is stage 3, and it's called the distribution. Okay. What about this distribution? When everybody um, seems to be buying, then who is selling them? So that's the question. So they're probably buying from the big funds who were able to accumulate in stage 1. Here, the big funds quietly sell in tranches to the public so as not to depress the price and halt the uptrend so soon enough. Despite all the buying frenzy, price isn't advancing anymore, and the enthusiasm of the people um, or the public is still there, but price cannot seem to get through the resistance at the highs of the range. Okay. Um, um, why is that so? So when you feel like everyone is buying but price isn't moving, and then there must be something big blocking the way. And at this point, institutions and big funds are distributing their shares to the public, the ones they accumulated in stage 1. Okay, in the chart, you'll see this as a consolidation after an uptrend. Volatility is usually higher in this stage than in stage 1, even though they're both consolidation. And if you ever wonder why, probably the reason is because market participation is already heavier in stage 3, and the deciding battle between the buyers and sellers swings price violently. And after some time, the buyers are starting to realize that price isn't going anywhere, and they start to doubt their positions. So these unstable holders, institutional sellers, and retreating buyers, they pave the way to the next stage, which is stage 4, markdown. Okay, markdown right here. It's where bids are dry and sellers are piling up, and those who came in late are now feeling long because probably they feel wrong. And to add insult to injury, news of low sales or probably rumors of management problems come out of nowhere. Then there's fear. Fear sets in and panic selling starts. And this then leads to a breakdown. And at this point, the big funds are not buying anymore. That's why the price seems to be free falling. So price now enters a downtrend. So it's a series of lower highs and lower lows. The public sells on panic, and the more seasoned traders who were caught at the wrong side, they sell on rallies. Here we have the counter trend traders who try to catch the rebounds and then sell on rallies with little profit, perhaps. And then institutions and big funds, they start buying as the trend matures, and then the cycle begins again. All right. Now, um, I think in the references that you will find it, um, you will also need to note that perhaps it's not the intention to make the public look a little bit gullible and make the big funds and institutions look like they're crooks or who manipulate prices. You see, if you're in the shoes of the big funds, you'll probably do the same thing, right? And if you're holding billions of shares of a stock, will you wait for the craze to die down before you sell? And you're most likely to sell as discreetly as possible when there are willing buyers grabbing your shares at prices that are moving higher and higher. And how do you think the public will react if you show your cards and let everyone know that you're disposing your million shares as soon as possible? So buyers will retreat and price will be depressed. And then you will be left with millions of unsold shares of a declining stock. So that wouldn't be what you probably desire. Okay. So to sum it up, the stock market really is a battlefield where everybody is trying to outsmart everyone else. That's a little bit true. And the big funds and institutions are not bad. They're probably just trading the way they have to, and they're managing their portfolios um, and whatnot using strategies that are fit for their size. They have their own battles to fight, no? Okay, and you or me or us, on the other hand, we do not have the money or the time that the big institutions have. But what we can do is master our timing. And as you've noticed, the crowd is usually late in buying and selling, so you must be more cautious or careful in following the crowd. Okay, the chart that you have with you is the same chart that the big institutions have, and you share something with the giants, no? And you have to know how to use it to your advantage. Analyze the big funds moves. That way, we recognize how the money flows while watching the trend with our eyes. So, as they say, and to quote, trade with the trend. Do not fight the whales that create the waves, and instead ride the waves that they make. All this trading and the timing um, strategies you learn as will go along, and you have to think and plan the different steps ahead if you really intend to outsmart the smart money. So that's all there is to it. I think it will stop here for now, relaying what I learned previously, but essentially that's it. If you like this video, uh, and you'd like to see similar videos in the future, don't forget to like, comment, subscribe to my YouTube channel down below, and hit the notification bell as well so that you don't miss out on more learning videos. Thank you so much, and bye for now.